Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, stock, there are actually times where I like to buy stock. All right, when you think a stock is going to move and vol is really high, you're better off buying the underlying, at least from a profit and loss standpoint. And I actually tell my students that if you like an underlying and then you look and see that vol is really high, don't buy calls, buy the stock. And the reason being that that vol component can actually hurt you. You know, here's one where I'm showing you should buy the stock. The stock, you know, this is trading about 15 bucks right here, but vol is sitting in at 32%. Well, we quickly rally to $16, but in that process of rallying, you see vol drop, you know, below $28, right at about 28%. That's 4 points. That's a significant amount, and that can actually affect your trade. So that's something I would really strongly encourage you guys is that if you see a really high volatility, even if you think the stock is going to move, unless you think the stock is going to completely blow up, you know, the stock can be a better trade, or the ETF in this case. Now, I point out another trend, another spot where calls make some sense. You can see, you know, here's one where I'm pointing out, you know, we're kind of sitting on a low. If you bought calls here, even as this thing fell off to maybe $16.50 and then ran up to $18.50, you were probably a happy camper that you bought these calls. My guess is that you probably didn't eat a lot of loss here. And then because you owned that volatility, you probably weren't paying a ton of as much decay as you probably thought because you bought a really cheap volatility. So the times to buy a stock are times when you've got or an ETF, are times when you're expecting a bigger move and the IV is really high. All right? Bearish. All right? The same general guidelines apply to bearish approaches. You buy puts when vol is low, stock is high, and a quick move is expected. All right? If you're going to sell calls, you would sell calls when volatility is high, stock is high, and you're kind of expecting a slower move or no move. I like to equate selling options, selling calls, and selling puts as to not expecting the stock to go up or not expecting the stock to go down versus when you buy a call, you're expecting the stock to go up. Or if you buy a put, you're expecting the stock to go down. And then shorting stock or shorting an ETF. The first thing to check before you do anything is the ETF easy to borrow? This is something a lot of people don't pay attention to. And it can really kind of, you go in and you try and sell the underlying, and if it's hard to borrow, you're going to kind of all of a sudden realize, hey, you know what, I can't sell this thing, or I've got to pay a big interest rate on this thing. The stock is high, vol is high, and a quick move is expected. So if you've got high vol and a high stock, I like shorting stock actually better than I like selling or buying puts. And I could go through and point out a bunch of different examples of this, but you know, it's basically do the opposite of the different examples I've shown here. If anybody'd like to see examples, I'd be happy to show them. Somebody said, but high FXI, thank you. But high IVs imply large movements. So does that mean to be careful? Yeah, you know, implied volatility is a good indicator. It's right a lot. But you would be surprised how often it's two right. An expensive straddle is trading $7, and then the stock moves $7. Well, guess what? You made nothing. You buy an expensive put, that's when, or an expensive call, that's where you can run into a lot of problems owning. Raise your hand if you felt this, all right? You buy a call in a stock like Intel or Cisco or Google or Apple into earnings. The next day, you're right, all right? The stock moves exactly the way you're expecting. The problem is your options don't move the way you're expecting. You actually lose money or don't make money. Anybody ever seen that? Yeah. Well, that's because of volatility. You know, that volatility gets sucked out. You cannot underestimate the power of that volatility component. And that's what I mean by that. All right, now let's talk about trading a vol trend. This is something that a lot of people aren't used to, and it's a little difficult, and it's tricky. And before you trade a vol trend, obviously learn how to trade these different products. All right, learn how to trade a straddle, learn how to trade a butterfly or a condor. But those can be a valuable tool in to traders. All right, trading a volatility trend can be just as good as trading a stock trend, and it's actually my favorite way to trade. I found that when I trade a vol trend, the stock trend ends up working out. That's exactly what I was doing in Eli Lilly today. So let's take a look. Let me give you an example of something. We've got, if vol is really low, okay, just across the board, since vol is mean reverting, if you buy when volatility is low, all right, you can really take advantage of the uptick in volatility, and if the stock moves. You know, this is a really great example that I have here. I was looking, this is, I want to say, kind of June, July kind of range of 2010. And you could buy this straddle for $1.40. It was the 13 straddle in August, right? So here we are in July, and you could buy an August straddle for $1.40. And lo and behold, we get to August, and look at how this straddle is done. Well, you probably could have sold out right here because volatility explodes. We go from about 33 to 46%. That is a massive shift. At the same time, but if you didn't want to, you know what, your purchase price, if you look across here, pretty safe. You don't end up getting beaten around by volatility. And actually, once we rally, you actually end up doing pretty well. You know, we break out 15, the straddle makes money. And at no point in time were you really nervous. You know, here if you got in at 13, you might have been out the next day when that vol popped. All right, let's take a look at that real quick. That is, I'll go back to August. That was a period of time we were looking at where, I want to say, was that 09 or 010? It was 09, all right. So here we are. We're going to go to July 09. We'll bring it up to September. So here's your chance to buy volatility, and here's your straddle price at $1.40 that we were looking at. All right. So the next day, you know, or in the days coming, this thing pops out, and drops down to a low of 11.02. So your $13 straddle already is worth $2. And obviously this is before. You guys must have just been introducing this thing.
Might have been.
The option prices, well, they've got option prices here, so I don't know why. I can see trades. I don't know why they're not giving us here. Now, here we are. So here we go. We've got, let me get to that low. Here we are. We're at 1160. That vol's way up. That AUG 13 straddle that you bought for $1.40, it looks like you could probably sell it $2 right now. You've been in it for, let's see, today is the 2nd. That's my birthday. That was my 30th birthday, actually. I'm an old man now. I'm a ripe old age of 32. And here, and you're out by the 8th. I think there are worse things than that. I don't know about you. But that straddle, here we are on Wednesday, on July the 8th. Your August straddle that you got in for $1.40, you could probably get out at, you could sell that thing at $1.90, no problem, probably $2. That's 60 cents in 6 days. It's better than a kick in the shin. And why did that work? Well, because you bought low volatility. Now, it doesn't always work, so that's why understanding how to trade volatility can be really important. On the short end, it's kind of the same thing. There are opportunities to sell vol when it gets kind of high. An opportunity I would look at would be just kind of looking at this price chart. This one's kind of crazy. If you sold right here in Jan, you sold a straddle, if you sold a condor, you can see that vol kind of just meanders. If you sold the 14, 15 strangle, or even the 13, 14, 15, 16 iron condor, you're a happy camper. Basically, this kind of whole time period. Actually, I'm sorry, Jan. I meant July. Actually, it was in August. So, how do you trade the right edge, bearing in mind you don't have full hindsight view at that point? Well, the neat thing about us as the retail public, there are a lot of people out there that say you don't have edge. I strongly disagree with them. Strongly. Okay? You do have edge. Your edge is the ability to initiate. Okay? Now, you're right, we don't have foresight, but you can only do to the best of your knowledge. So if you can only kind of trade to what is a favorable trade. And what I found is that if you learn your fundamentals, you learn volatility really well, you learn options really well, not just kind of namby-pamby, here's what the Greeks are, you don't need to know the hard stuff, but if you really dig into the hard stuff and you learn about volatility and skew and term structure and how all the Greeks are interrelated with those, all right, you can enter more favorable trades. They may not all win, okay? They absolutely may not all win. But over time, people that enter favorable trades end up winning, okay? It's like if you walk into a casino where they're paying out $52 on a coin flip game. You may lose 4 or 5 times in a row, but you play that coin flip game enough, you'll end up winning. But it takes knowledge and understanding of the fundamentals. So that's something I would point you guys toward. Hopefully that answers your question. So, moving on. Moving on. Picking a top or a bottom. This is something that I've gotten really pretty good at, and it's not easy, and it takes a lot of work. And you shouldn't just say, okay, you know, vol's high, we're at a top, or vol's low, we're at a bottom. You really have to see the price action. But when IV is at its highs and stock is at its lows, that can really mean a bottom. All right, especially if that, and I'll talk about term structure here in a second. Especially if the term structure is screwed up. And then when IV is at its lows and a stock is at its highs, that can absolutely be a top. So let me kind of show you some points here. If you look here, and I just kind of quickly kind of drew out some different things. You know, this one's a little more opaque. But let's kind of start from the left. Here is a peak in vol, and look what happens to stock. It's bottomed out. And it kind of takes off. Now, here we have a big dip in vol. You know, we go from 46 to 34. What happens to the stock? You know what? It quickly turns around. Here's another pop in volatility. Here's another bottom. Then we kind of we rally up. Vol flattens out. See that flattening? Then we kind of drop off. Now you see another big peak in vol, and then you see the market rally. Vol kind of flattens out. Market kind of begins to stop. Vol spike, rally. Vol, you know, here's a really mini vol spike, but it's kind of showing a kind of dip on a long-term trend. And then we have this is where it takes some work to not get caught. You know, here we have the flash crash coming in over here. When you get into something like this, when that vol drops, if you see this thing quickly turn around and get right back to where it was, that is a very bad sign. All right? When I see boom, when I see spike, dip, spike, that tells me that is my run for the hills. Okay? But using volatility, so how can you use this as somebody that maybe isn't, you know, really attuned to analyzing vol? One, start learning vol. But initially, one thing you can do is when you're looking over stocks, if you like a stock and you think it's really on its lows, take a look at that volatility. If that vol is really kind of peaking out, that could be a good hint that you know what, maybe this thing is kind of set to rally. And I'll show you a quick example. I wasn't going to talk about this, but I want to kind of talk about term structure.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.